What's going on, guys? Today I'm going to be running us down through the ICT silver bullet model. I'm going to be doing a full breakdown of this model, sharing a live example, and also I'm going to be adding a couple more crucial topics throughout this video. So before we even get started, what even is the ICT silver bullet model? The ICT silver bullet strategy refers to a high probability intraday reversal setup that occurs during a 30-minute time window. Usually we only get one trade setup that occurs from 9:45 to 10:15 AM, which is referred to as the first AM macro, or from 10:45 to 11:15, which is referred to as the second AM macro. Usually we only get one trade setup in one of these AM macros, or if we're lucky enough, we could get a trade setup in both of them. I'm really sorry guys for already interrupting the video, but I do highly suggest you guys go follow the Instagram at daily_trade_recaps. I post trade recaps on a daily basis, showing you guys my entries, my stop loss, and where I take my profits. I do really highly recommend you guys follow if you do want to improve your trading and have a visual approach on a day-to-day basis on what the ICT silver bullet model looks like. Okay, so let's get back to what we were talking about. The ICT A+ silver bullet checklist criteria. The first thing when I'm looking for when I get on the charts is number one is a sweep of liquidity. I want to see either London highs or London lows, Asia highs or Asia lows, previous day high or previous day low, buy side or sell side liquidity level get swept. This is a very crucial step. Without this step, we do not have a trade. Usually, sometimes the market could give us the steps following without sweeping any liquidity level. The reason why I'm looking for a liquidity sweep is because the market tends to seek sell side liquidity to buy side liquidity and vice versa from buy side liquidity to sell side liquidity. Now, after we swept some sort of liquidity, whether it being a buy side liquidity or a sell side liquidity, the next step I'm looking for is a swing high or a swing low to be created. The reason why I'm looking for a swing high or a swing low to be created is because checkpoint number 3 and number 4 are related to that swing high or swing low being created. Checkpoint number 3. After the market has provided us with a swing high or a swing low, we are now looking for a market structure shift. A market structure shift is essentially breaking the latest swing high or swing low that is created. This market structure shift is a strong indication on where price wants to go. For example, if we just swept sell side liquidity and we get a swing high and we broke market structure to the upside, this indicates to me that the market is seeking higher prices and is willing to seek some sort of buy side liquidity. And vice versa, if we just swept buy side liquidity and we create a swing low and we break market structure to the downside, this indicates to me that we're seeking lower prices and price is willing to seek some sort of sell side liquidity. Now, coming into checkpoint number 4 is a displacement. A displacement usually occurs with the market structure shift. They're both paired together, and essentially what a displacement is, it's a large candle that closes above the swing high. So it is paired with the market structure shift. So for example, if price swept sell side liquidity and we create a swing high, that candle that we broke structure with should be a large up close candle that has a body close above that swing high. That is considered to be a displacement. Coming into checkpoint number 4 is a fair value gap. Usually a fair value gap is created when a displacement and a market structure shift occurs, where if we're talking in a bullish example, let's say we swept sell side liquidity and we had that swing high, we broke market structure with that displacement. A fair value gap is essentially a 3 candle pattern where the first candle's top wick and the third candle's bottom wick are not overlapping and there's an inefficiency in between. That is essentially just called a fair value gap. We need that fair value gap to form in order to continue on to the next step. And our next checkpoint on our criteria is a retracement into that fair value gap. A retracement into that fair value gap indicates our entry. As soon as price retraces into the edge of that fair value gap, we execute. We don't wait until price reaches the middle of the fair value gap or the bottom of the fair value gap or any other level of the fair value gap. No, as soon as price retraces into that fair value gap on the edge of it, we execute, whether that being we're going long or whether that being we're going short. Now, checkpoint number 7, our entry must be inside of the first AM macro, which is from 9:45 to 10:15, or the second AM macro from 10:45 to 11:15. This step is very important as within these time periods, there is a much greater probability of the trade panning out. The reason being is because there's more volatility in these time periods than there is around it. In my backtesting and collecting data from my trades, the trades that are taken inside the macro, 70% of them are winners and only 30% of them are losers. Whereas the trades taken outside the macro, 70% of them are actually losers and only 30% of them are winners. This shows how important it is to take the trades inside of the macro in order to have that higher win rate and avoid taking more losses than necessary. Checkpoint number 8, our stop loss. Where do we place our stop loss? Our stop loss goes above the nearest swing high or below the nearest swing low. Checkpoint number 9, we don't want to be risking more than 30 handles on NQ. Our max risk is going to be 30 handles or less. We don't want to be risking too little either. Anything from 25 to 30 handles is the most ideal. Why? Because we don't want our stop loss to be too close to our entry where price will stop us out. Checkpoint number 10. What are we targeting? Where do we take our profit? We're targeting opposing liquidity. That could be London highs or London lows, Asia highs or Asia lows, previous day highs or previous day lows, any sort of buy side or sell side liquidity, whether that being minor buy side or sell side liquidity, relative equal highs or relative equal lows. This is a very, very strong draw on liquidity, as price usually always draws to those equal levels. And finally, we could be targeting 50% of the range, and I'll get to what 50% of the range later in the video. Okay, here is an example of the ICT silver bullet model, so let's go through it. The first thing that we want to see is a sweep of liquidity, and in this example we get a buy side liquidity sweep. The previous day high level got swept on NQ, as we could see by this candle. Now the second thing that we're looking for is a swing low, in this case, to be created. Why swing low? Because this is a bearish example. A swing low got created right here. Now the third thing that we're looking for is a market structure shift, and the market structure shift is right here. We could see that as it breaks this swing low. This is considered to be a market structure shift. Now number 4 on our checklist criteria is a displacement. This candle right here displaces strongly to the downside. This is considered to be a displacement. Now checkpoint number 3 and 4, the market structure shift and the displacement, indicate to me that price is willing to seek lower prices. After that is our checkpoint number 5, which is a fair value gap, and we get that fair value gap right here. A fair value gap is essentially an inefficiency, and as we could see, the first candle's low and the third candle's high are not overlapping, and this is called an inefficiency right here. Number 6 on our checklist is what we're waiting for, a retracement into that fair value gap, and as we see right here, we get that retracement into this fair value gap, and that's where we enter short. We don't wait for price to get into the middle of the fair value gap or the top of the fair value gap. We execute as soon as price retraces onto the edge of that fair value gap, because sometimes price won't retrace all the way to the middle of the fair value gap or the top of the fair value gap, so we rather enter as soon as it retraces into it. As soon as we're in the trade, the first thing we need to do is adjust our stop loss. Our stop loss rests above the nearest swing high, as we could see right here, risking exactly 30 handles on this trade, and we'll be targeting these relative equal lows. As I said earlier, relative equal lows or relative equal highs are a very strong draw on liquidity. Price is usually always attracted to these levels, and as you can see, price absolutely delivers and hits our take profit. And something to note in this trade is the time that we took the trade in. As you can see, it's in between 9:45 to 10:15, which is considered to be the first AM macro. Now let's talk about a very important topic, which is risk management. We're going to be talking about risk management on a funded account, as most of you guys will be on a funded account. So let's say, for example, we have a $150,000 funded account. Let's say this funded account gives us $5,000 of drawdown. We only risk 10% to 15% of that $5,000 per trade. So 10% to 15% of that $5,000 will equate us to $500 to $750 per trade. We don't want to be risking less than $500. Ideally, we want to be risking from $500 to $750, so approximately $600. If you place a trade with one mini contract on NQ and risk about 30 handles, that will give you about $600 of risk, which is the most ideal. Let's say you have a live account of $100,000 of live funds. You only want to be risking $1,000 per trade. Very simple. Only risk 1% of your account if you're trading live, and only risk 10 to 15% of the permitted drawdown if you're trading on a funded account. Okay, so the next thing that we're going to be talking about is stop loss. Where do we place our stop loss? Usually, we're always going to be placing our stop loss above a swing high or below a swing low. Most of the time, price will allow us to place our stop loss below a swing low or above a swing high by not exceeding the max risk of 30 handles, but sometimes the nearest swing high or nearest swing low will exceed our max risk of 30 handles. So in that case, we typically want to be placing our stop loss above the displacement candle's high or below the displacement candle's low in order to only risk 30 handles, no more. And you don't want to be placing your stop loss close to your entries, as most likely price will take you out every time you execute, and if it doesn't 1 or 2 times, it will the 8 times out of 10. And also, you don't want to be placing your stop loss at the edge of the fair value gap right here. You want to be placing your stop loss in this scenario above this displacement candle's high, and in this scenario below this swing low. On this left scenario right here, if you decided to place your stop loss below this fair value gap right here on the edge, trying to reduce your risk as much as possible and not following the rules in placing your stop loss below the swing low, you would have been stopped out as soon as you executed the trade. And as you can see, price performs algorithmically, and it does not take that swing low, and it continues going up to that 50% range and price hits the target. The next thing that I want to be talking to you guys about is premium and discount. What even is premium and discount if you guys are new? It is constructed from a price range, and a price range is considered to be from a swing low to a swing high. This bulk of price is considered to be a price range. Now the top 50% of that price range is called a premium, and the lower 50% of that range is called a discount. And as you can see right here, this is called the 50% level. Price always tends to go from premium to discount and from discount to premium. This is simply how price just moves. A very important topic, guys, is where to take your profits. Now you might think this is a very silly topic. Oh, I'm just going to take my profits whenever I feel like it. Well, that's wrong. You always got to have a plan before you even execute the trade. Where your stop loss going to be, where your entry is going to be, and most importantly, where your take profit's going to be. Because you don't want to be too greedy. As soon as you see price running towards your target, you extend your take profit, you extend your expectation, and in doing so you're actually harming yourself. Because I've done this too many times, and I'm telling you right now, you don't want to be extending your take profit, because what happens is if you keep on extending your take profit, price is most likely not going to hit your TP, and it's going to reverse, stopping you at break even, or even worse, taking you out in a loss. You got to have a plan that is set out before you even execute. You place your stop loss, you place your limit order, you place your take profit, and you leave it there. And don't get greedy. There are some levels where you could take your profits, as I mentioned earlier, is the 50% of a price range, which, as I said before, is measured from a swing high to a swing low. Another target where you could take your profits are unfilled fair value gaps, resting inside of a premium or a discount. Again, price usually always tends to go and fill in a fair value gap above a premium or below a discount level. Now, the third thing you could be targeting are swing highs or swing lows. These are pretty much called minor buy side or sell side liquidities. The fourth thing you could be targeting are internal range liquidity, which are buy side or sell side liquidity. And the fifth thing you could be targeting is external range liquidity, such as London highs or lows, Asia highs or lows, previous day highs or lows. These are called external range liquidity because they are outside of the price range. Now, coming into one of the most important topics that nobody really talks about, but it's very crucial, is asset correlation. What asset correlation is essentially both NQ and ES must be correlated in order to have a high probability trade, which means you want to see the same price action on both NQ and ES. For example, if after a market structure shift and displacement on both assets occur and we get a fair value up on NQ but not ES, this means that both assets are not correlated, and this is a very low probability trade. You always want to see both assets doing the same thing, not identically the exactly same thing, but extremely close. Now, looking at these examples of assets that are not correlating, as we could see, we've got NQ on the left hand side and ES on the right hand side. In this example, we have London highs that just got swept. We got that swing low. We broke market structure. Market structure shifted with a displacement. But as you can see on the right hand side on ES, we do create this same swing low, but we do not get the same market structure shift or displacement on ES. Right there and then, I would stop and not even consider this a trade, and I would move on and see what price will do. Will it come back and break this swing low? If not, then I'm not interested in the trade. And as you can see, a lot of people might fall into this mistake and see this trade on NQ as an A+ setup, which, to be honest with you, it does look like a great setup without looking at ES. But as soon as I look at ES, I'm seeing that this is an absolute low probability of a trade, as we do not have both assets correlating. Thank you guys for watching this video and tuning in. I hope this was helpful and you guys got something out of it. If you guys got any questions, make sure to drop them down in the comments down below, and I'll be sure to get back to them and answer them as soon as I can.